I love stock market recessions. Knowing exactly what to do during these downturns can actually make you money while others are losing it. Investors everywhere have recently been talking about a potential downturn due to the recent economic factors and events. And please don't get me wrong, recessions can cost people their futures and their careers even if they're not invested in the market at all, so it's very bad that one can possibly be happening. But if you keep these few things in mind, you could potentially end up better than a lot of the other people during any recession that may come in the future. Let me show you how. Hey everybody, this is your young advisor, and today I'll be teaching you how to survive and possibly beat a market correction or recession. One thing I do want to point out, this is not investment advice. I am not licensed, so please invest at your own risk. That being said, let me tell you a few things about recessions and market corrections. Knowing the context of one is very crucial because knowing what caused it can potentially help you to prevent those losses. For example, the correction we're experiencing right now is due to the recent tariffs in place by the government, because that's sparking concerns about the global trading and manufacturing industries. And one thing about that, most major companies in America have international ties, so they have been taking hits as well due to that. But whether we like it or not, the purpose of these tariffs is to boost American-made manufacturing for American consumers. That being said, since the start of the year, the market is down 5%, but American-made company Duke Energy that provides energy to American consumers is up 12% throughout that same period, because these tariffs focus on American-made companies that provide American-made products. So investors in Duke Energies haven't even seemed to flinch because these tariffs are in place to support companies such as Duke Energy. And this same situation can also apply to the 2008 recession. So knowing the concept of that can explain why several companies ended up closing green year over year throughout those recession years, even though why most of the economy was crashing. So in 2008, while most companies were taking severe losses and even going bankrupt, companies such as Walmart and McDonald's were thriving because they had low-cost products that the consumers in those times really valued. That just goes to show why knowing the context of any recession or correction can really put you in the advantage and help you pick the right stocks for your investments to hopefully end the year green. But regardless, sometimes it's really hard to find those stocks that are 1 in a million chances to still end up green even though why everyone else is crashing. So that being said, knowing how to properly protect your money can be very important as well during any correction. The biggest and most known word in the investing world is going to be diversification. That alone can help you reach the most stable returns as possible and help protect your money during any downturns, to a certain extent though. Historically, the S&P 500, which some investors call the market itself, has averaged 10% year over year over the last hundreds of years, including drops from the Great Depression in 1929 as well as the 2008 Great Recession. So keeping your money invested throughout different industries and companies which the S&P 500 mirrors can make any recession or market correction seem like a bump in the road when it comes for the longer term picture. Having a few bond investments that provide stable income while those stocks may be dropping can still be very beneficial because that money invested in bonds can generally be more safe than stocks during any correction. Going on to more stock strategies, there are a few things to keep in mind when picking those stocks. The first thing you want to know is what types of industries you're investing in, whether it's defensive or cyclical. Stocks in defensive industries such as Duke Energy and Walmart that we previously talked about are going to be considered defensive because no matter the economic outlook, those companies are always going to be needed. People are always going to need to power their houses with electricity or feed their families with food, so those companies are generally going to be more stable or take less losses than other companies during any corrections. On the other hand, those cyclical companies such as travel companies and hotels are going to take more of a hit because during bad economic times, people are going to be less apt to take cruises and vacations while their money is shrinking. So those companies in those industries tend to do a lot worse. Also, the size of the company you're investing in matters as well. The bigger the company, the more likely they have cash reserves and stable money coming in to prevent them from going underneath during any correction, which can bail them out during any bad financial situation. But smaller companies don't have that same financial protection, so they tend to get the worst of it. So again, going back to Walmart, they're a billion-dollar retail company and they offer low-cost items, so that's going to be both going hand in hand during any correction, which is why they still ended up green during that 2008 recession. The third thing you want to consider is if the company gives investors dividend income. Getting paid your dividends can add an incentive because even while your share values may be losing value, you could still be getting stable income from that company for the most part, which compared to losing your value and not receiving any money at all will make it a lot better. So those companies that provide dividend income tend to perform a little bit better during corrections compared to companies that don't provide them at all. So finding those companies that are big in value, defensive industries, as well as providing income can provide a very nice shelter during any corrections or downturns in the market while you're holding out. But even then, if you're still losing money, that can be a great opportunity to buy even more shares. For example, these recent downturns are more than likely to be temporary as investors shift their money to better and safer investments. But that being said, most companies that were performing great before this downturn will continue to be great, assuming they adjust for these tariffs, meaning they will continue to grow in price, if all goes well. As we saw during COVID in 2020, most companies took massive hits in a couple of days, but since then, those companies have reached record highs that we could not even predict it. So people that invested during those sharp downturns and seeing those record highs right after are basically swimming in money right now. So let this be the time that you can invest in Tesla, Nvidia, and Apple for these discounted prices before they go back up. Because as previously mentioned, the market has historically shown 10% annual returns. So no matter what, 9 times out of 10, the market is going to continue to grow and recover from this. That being said, knowing these few things can put you ahead of most investors and even any potential recession. But please invest safely and at your own discretion. Again, this is not investment advice. I am not licensed, so please do it at your own risk. But to wrap it up, thank you guys for letting me be your young advisor today and teach you how to protect yourself during any potential market recessions or corrections. Let's all get rich 2025, and knowing these few things can help you potentially get there. Thank you guys again, and hope I catch you in the next video. Thank you. Have a great day.